A major falsehood conveyed by banks is that our money multiplies within our bank accounts. The reality is, although the sum increases due to its interest, its actual worth or value doesn't expand. Given the steep surge in inflation rates and the considerable lag in bank interest, stashing money in the bank is essentially eroding your funds. This video aims to outline 7 assets that can prevent the gradual loss of wealth and assist you in building long-lasting generational prosperity. First, precious metals, gold, silver, and platinum. A major rationale behind money's perceived importance lies in its function as a means to retain value for the future. Yet, contemporary governments continually produce additional money to support their financial gaps. Consequently, it's uncertain when the currency note you identify as the dollar might lose its value entirely. This clarifies why financial experts suggest putting your money into something valuable that is limited in supply and is not easily producible. This stands as the primary explanation for why wealthy individuals consistently allocate a portion of their investments to precious metals. Assets like gold, silver, and platinum will invariably experience an increase in value during periods of rampant inflation. Prior to the 1950s, you could purchase an ounce of gold for $400. Fast forward to 2023, and that same ounce now commands a price exceeding $2,000. According to PrimeXBT's gold projections, this figure is anticipated to soar to $10,000 by 2032. In essence, over the span of approximately a decade, your investments in gold would multiply by 5. Thus, as the value of cash continues to decline, the worth of gold consistently ascends. Likewise, alternative precious metals outperform keeping money stored in a bank account. If you're contemplating how to incorporate gold into your investment portfolio without directly purchasing physical gold, an option is to invest in gold exchange traded funds or ETFs. These gold ETFs serve as cost-effective investment instruments, offering returns tied to shifts in gold prices, all without necessitating the ownership of physical gold. Second, industrial commodities, raw resources. While scarcity contributes to the classification of precious metals as precious, their inherent practical usefulness is equally significant, rendering them crucial industrial commodities. To illustrate, silver finds application in the manufacturing of electronics, medical devices, nuclear reactors, and more. In a parallel vein, additional metals like cobalt, nickel, and copper are in great demand within industries due to their unique attributes that cannot be effortlessly replicated by substitute materials. To provide a more distinct illustration, the demand for cobalt has experienced an exponential surge since 2020. The primary driver behind this surge is its essential role in crafting batteries for electric vehicles. Correspondingly, its market prices have surged from $20,000 per ton in 2012 to a staggering $40,000 in 2022. This signifies a remarkable 100% escalation over the span of a mere decade. Consequently, possessing investments tied to such fundamental resources can notably enhance your portfolio's performance during periods of elevated demand. Nonetheless, it is not feasible for everyone to allocate substantial funds towards procuring raw resources, nor is it practical to physically amass and vend them. Hence, opting to invest in stocks of mining enterprises like Rio Tinto, mutual funds with a mining focus, or even financial instruments like futures and options emerges as excellent strategies to attain such exposure. Third, secure reserve currencies. In the contemporary landscape of fiat currencies, where no currency finds backing in gold, geopolitical steadiness serves as a pivotal consideration when determining where to invest your funds. This explains why affluent individuals consistently opt to deposit their funds in Swiss banks. Switzerland, with its robust economic structure, presents an inherently more dependable geopolitical atmosphere. Hence, the Swiss franc earns recognition as a secure haven asset. During periods marked by turmoil and uncertainty, We have repeatedly observed this phenomenon. To illustrate, amid the Eurozone debt crisis in 2009 and the worldwide financial crisis in 2008, substantial capital shifted from those nations to Switzerland, aiming to avert the erosion of wealth resulting from currency devaluation. Additionally, the Swiss franc effectively serves as a valuable substitute to the US dollar for global trade transactions. A recent illustration of this is seen in the context of the Russia-Ukraine crisis. When the United States enforced sanctions on Russian energy trade, Russia engaged in transactions using the Swiss franc. This sequence of events propelled the demand for the Swiss franc, resulting in a remarkable surge in its value compared to all other currencies. In the beginning of 2023, a single Swiss franc commanded a value of 1.1074 US dollars, enabling holders of the Swiss franc to substantially amplify their wealth virtually overnight. Hence, robust currencies like the Swiss franc, British pound, and the Chinese yuan proved to be excellent reservoirs of value. However, since not all individuals can establish Swiss bank accounts, currency exchange-traded funds and forex brokers like Forex.com serves as an option for smaller investors to acquire currency exposure with a minimal initial investment, often as modest as $100. Fourth, government backing. Have you ever scrutinized the dollar's details? It bears the inscription, "This note is legal tender for all debts, public and private." Have you ever pondered its significance? Since 1971, when President Nixon eliminated the gold standard, the US dollar has obtained legal tender status according to US law. This attribute bestows value upon it as a medium of transaction, leading us to regard it as appropriate compensation for any product or service. Even though no fiat currency globally is underpinned by gold or any tangible asset, they continue to derive their value from the unwavering trust and assurance of the governing body. In simpler words, the stability of your money is contingent upon the stability of the government supporting it. This clarifies why investing in government backing stands as a valuable method for preserving value. The government of any country is invariably the ultimate entity to encounter default. If the government defaults, it signifies a nationwide default, and no competent government would willingly allow such a situation to arise. Hence, one of the most secure avenues for investing in government banking is via government securities, commonly referred to as GSECs. However, it's prudent to consider solely stable government GSECs with credit ratings that denote investment-grade quality. Recall the sovereign debt crisis that unfolded in Greece back in 2009. The International Monetary Fund, or IMF, the Eurogroup, and the European Central Bank, or ECB, had to intervene repeatedly to rescue the nation from its debt woes. This instance highlights the significance of assessing a government's worldwide robustness when contemplating investments in GSECs. In the United States, individuals have the opportunity to invest in treasury bills, notes, and bonds, which provide exposure to guarantees from the government. These options yield superior returns compared to simply holding funds in a bank account. Furthermore, these investments are supported by the robustness of the US government within the worldwide economy. Individuals with limited funds can make purchases of Treasury securities directly through the Treasury Direct website or via the secondary market. Fifth, consider value stocks and mutual funds. While Treasury investments certainly outperform holding cash in terms of returns, it's important to note that they yield lower returns compared to stocks due to their lower risk nature. While lower risk is a vital factor for investors who are averse to risk, the majority of investors aim for higher returns, and stocks present an effective method of attaining those higher returns. Furthermore, it's important to recognize that stocks don't carry uniform levels of risk. In reality, the stock market can be categorized into two main types: value stocks and growth stocks. Growth stocks, like those in the technology sector, pose higher risks due to their involvement with concepts and technologies that have a significant possibility of failure. On the other hand, value stocks like Nucor, a company focused on industrial metals present lower risk due to their established demand projected into the foreseeable future. Hence, value stocks with robust underlying strengths not only deliver consistent and secure price growth, but also offer reliable dividends. Nevertheless, delving into the fundamentals of each individual value stock can turn into a laborious and time-intensive task, particularly for regular investors. This is where dividend-centric mutual funds come into play, such as the Vanguard High Dividend Yield Index Fund Admiral Shares. These funds boast a history of dependable dividend payouts and are both well-suited and cost-effective investment options for everyday retail investors. Sixth, land and real estate. Accountants view land as an asset that doesn't lose value over time for a highly justified reason: its scarcity and constant demand. Throughout history, land has consistently stood as one of the most precious resources globally, essential for purposes ranging from housing and education to industry, farming, and business locations. Land's significance remains unparalleled. Furthermore, given the continuous growth of the human population, its demand is set to remain steadfast. Likewise, residential houses, office buildings, and commercial establishments constructed on these plots of land consistently maintain their desirability. Consequently, both land and real estate serves as effective safeguards against inflation within your investment portfolio. To illustrate with some figures, a Bloomberg analysis reveals that housing prices have experienced a threefold increase from 1992 to the 2020s, even accounting for a substantial decline during the 2008 housing bubble. Consequently, maintaining a presence in the real estate sector proves advantageous when the value of the dollar begins to decline. Nevertheless, a majority of small-scale investors tend to consider entering the real estate market much later in their lives, often associating real estate solely with their primary residence. While possessing a mortgage-free home is a target for building net worth as you reach your 40s, it's advisable to consider a stake in the retail property market at any stage of life. Contrary to the prevailing notion, amassing a substantial sum of money is not a prerequisite for obtaining exposure to real estate. An alternative route involves investing in REITs, or real estate investment trusts, which function akin to mutual funds but are centered around real estate assets. Notably, Ventas Inc. or VTR ranks among the most renowned REITs in the United States, specializing in healthcare real estate that encompasses senior housing, research facilities, hospitals, and more. Alternatively, another approach is to leverage borrowing to acquire rental properties. The rental income would address expenses and mortgage payments while also yielding profits. And lastly, collectibles. This category encompasses vintage automobiles, scarce artworks, meticulously crafted luxury handbags, limited edition timepieces, and even inaugural editions of iconic literature. While ordinary cars typically experience a 50% depreciation as soon as they hit the road, vintage cars defy this trend. Analogous to fine wine, their value appreciates over time. Indeed, as reported by Autocar, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe fetched an astounding 135 million euros in a 2022 sale. The rarity of this model, with only 2 ever manufactured, designates it as a coveted collectible among automotive enthusiasts. Equally noteworthy, Leonardo da Vinci's highly debated masterpiece, Salvator Mundi, commanded a staggering $450 million at a 2017 Christie's auction, securing a purchase by a Saudi prince. The rationale behind affluent individuals investing substantial sums in limited edition items lies in the fact that these distinctive creations serve as enduring storehouses of value. With the potential to command incredibly high prices when matched with the right buyer, these pieces are essentially timeless assets. However, for ordinary investors, the prospect of investing in collectibles might appear as an unattainable aspiration. As a result, virtual marketplaces like Whatnot offer excellent avenues for selling uncommon baseball cards, comic books, action figures, and a plethora of other collectibles. Moreover, if acquiring the entire item seems unfeasible, you can explore other platforms like Convey and Masterworks, which enable investments in fractional ownership of collectibles. What do you think? Which of these assets are you looking forward to investing in soon? Tell us your thoughts in the comments below. Thank you so much for watching. If you haven't already, click the like button, subscribe to the channel, and turn on notifications to stay up to date with our latest uploads.